Good? Everybody good? Morning, everyone. I'd like to call this meeting of the FDIC Board to order. We need a sunshine motion. Would someone like to make a sunshine motion?
So moved.
Thank you. And a second?
Second.
Thank you. All in favor, please say aye.
Aye.
Those opposed? The motion is adopted. We have several items on the summary agenda this morning. Are there any questions or comments on the summary agenda? If none, may I have a motion to approve the summary agenda? Thank you. And a second?
Second.
Thank you. All those in favor, please say aye. Aye. Those opposed? The motion is adopted. We have two items on the discussion agenda this morning. The first is a memorandum relating to the semi-annual update on the Deposit Insurance Fund Restoration Plan. Ashley Mihalik, Dan Hupel, and Ryan McCarthy will present the case.
Good morning, Chairman Grunberg and members of the FDIC Board. I am here today to deliver the first semi-annual update of 2024 for the restoration plan of the Deposit Insurance Fund. The Deposit Insurance Fund, or DIF, has operated under a restoration plan since 2020 after extraordinary growth in insured deposits caused the DIF reserve ratio, or the ratio of the fund balance to insured deposits, to fall below the statutory minimum of 1.35%. The plan maintained the assessment rate schedules in place at the time and required staff to monitor and provide at least semi-annual updates on potential losses, deposit balance trends, and other factors that affect the DIF balance and reserve ratio. In June 2022, the board amended the restoration plan based on projections indicating that the reserve ratio was at risk of not reaching the statutory minimum by the deadline of September 30th, 2028. Pursuant to the amended restoration plan, the board subsequently increased deposit insurance assessment rates for all insured depository institutions by 2 basis points. The revised assessment rate schedules became effective January 1st, 2023. Under the amended restoration plan, staff also continues to monitor and update analysis and projections for the DIF balance and reserve ratio at least semi-annually. The following is the first update of 2024 based on data as of December 31st, 2023. At the end of 2023, the DIF balance totaled $121.8 billion, up $4.8 billion from June 30th, 2023, as presented in the previous semi-annual update. The increase in the DIF balance combined with insured deposit growth resulted in a 4 basis point increase in the reserve ratio from 1.11% as of June 30th, 2023 to 1.15% as of December 31st, 2023. Growth in the DIF balance was largely attributable to assessment revenue, which totaled $6.4 billion for the third and fourth quarters of 2023. Investment contributions, which include realized and unrealized gains and losses on available for sale securities, further increased the DIF balance by $1.7 billion. Loss provisions of $2.1 billion and operating expenses of $1.1 billion partially offset these increases in the DIF balance. Additional provisions were primarily driven by a $1.6 billion increase in the estimated losses associated with the 3 regional bank failures in the first half of 2023. This amount does not include the portion of additional losses attributable to protecting uninsured depositors pursuant to the systemic risk exception announced following the failures of Silicon Valley Bank and Signature Bank, as the FDIC is required by statute to recover those losses through special assessments. The increase to the DIF balance of $4.8 billion in the second half of 2023 outpaced growth in insured deposits, resulting in the 4 basis point increase in the reserve ratio. Over this period, insured deposit growth slowed relative to the first half of 2023, as insured broker deposits and reciprocal deposits grew at a more moderate pace, and balances of other insured deposits continued to decline. As of December 31st, 2023, annual insured deposit growth was 3.6%, almost a full percentage point below the long-term historical average of 4.5% from 2000 to 2019. Looking ahead, staff expect insured deposit growth to remain at or below the historical average in the near term. Future growth in insured deposits, however, is uncertain and depends on several factors, including the outlook for the economy, inflation, interest rates, and consumer behavior. Staff also project the DIF to incur a low to moderate level of costs associated with bank failures over the next several years. This projection reflects the continued resilience of the banking industry following a period of liquidity stress in early 2023, as well as overall asset quality metrics that remain favorable at year-end and liquidity levels that stabilized in the fourth quarter as total deposits increased for the first time in 7 quarters. Despite this resilience, the industry faces some challenges ahead. While the non-current loan rate remains below the pre-pandemic average, non-current loan balances and net charge-offs have increased, driven by commercial real estate and credit card portfolios. Funding and earnings pressures continue to challenge the industry, while unrealized losses in security portfolios remain elevated. The banking industry also continues to face downside risks from persistent inflation, volatility in market interest rates, and geopolitical uncertainty. Finally, looking ahead, assessment revenue is expected to remain the primary contributor to growth in the DIF balance, supported by the 2 basis point increase in assessment rates that became effective at the beginning of 2023. This increase will remain in place until the reserve ratio reaches 2%. Taking into account these factors, staff continue to project that the reserve ratio is likely to reach 1.35% ahead of the deadline of September 30th, 2028. While subject to uncertainty, staff project that the reserve ratio will most likely reach the statutory minimum in 2026. However, it is possible that the reserve ratio could reach 1.35% earlier or later than 2026 if losses for bank failures or insured deposit growth materially differ from staff estimates, or if yields on DIF investments materially deviate from current market expectations. The challenges faced by the industry could also have longer-term effects on the condition and performance of the banking industry that exacerbate the risk of losses to the DIF. The increase in assessment rate schedules that became effective on January 1st, 2023, however, will continue to strengthen the DIF, increasing the likelihood that the reserve ratio will reach the statutory minimum by the deadline and promoting public confidence in federal deposit insurance. Staff recommend no changes to the amended restoration plan at this time. Under the amended restoration plan, staff will continue to monitor potential losses, deposit balance trends, and other factors that affect the reserve ratio, and update projections at least semi-annually. Staff continue to believe that frequent updates are warranted to incorporate updated information, and because loss and reserve ratio projections are subject to considerable uncertainty. Staff plan to provide the next semi-annual update in the second half of 2024. Thank you for your time, and we are happy to answer any questions that you might have.
Great, thank you. Thank you. That was very helpful. I have a brief statement, and I'll then turn to other members of the board. As required by the Federal Deposit Insurance Act, the FDIC has been operating under a Deposit Insurance Fund restoration plan since September 15th of 2020. At that time, extraordinary growth in insured deposits caused the Deposit Insurance Fund reserve ratio to decline below the statutory minimum of 1.35% that occurred on June 30th of 2020. The restoration plan is intended to restore the DIF to the statutory minimum of 1.35% within an 8-year deadline required by statute. That deadline is September 30th, 2028. On June 21st of 2022, the FDIC Board amended the restoration plan based on analysis indicating that the reserve ratio was at risk of not reaching the statutory minimum of 1.35% by the September 30th, 2028 deadline. In conjunction with the amended restoration plan, the board proposed and subsequently finalized an increase in initial base deposit insurance assessment rate schedules of 2 basis points to improve the likelihood that the reserve ratio would be restored to at least 1.35% by September 30th of 2028. The amended restoration plan requires the FDIC to update its analysis and projections for the DIF balance and reserve ratio at least semi-annually, and if necessary, recommend modifications to the amended plan. Since the previous update, the DIF reserve ratio increased by 4 basis points from 1.11% as of June 30th of last year to 1.15% at the end of last year, as the growth in the DIF balance in the second half of 2023 outpaced insured deposit growth. In this first semi-annual update of 2024, the DIF balance totaled $121.8 billion as of December 31, 2023. That's up $4.8 billion from the previous update that was provided in June of last year. The increase in the DIF balance was primarily driven by assessment revenue. Staff project that the reserve ratio remains on track to reach the statutory minimum of 1.35% ahead of the statutory deadline, and recommend no changes to the amended restoration plan at this time. Reaching the statutory minimum reserve ratio in advance of the statutory deadline strengthens the deposit insurance fund so that it can better withstand unexpected losses and reduces the likelihood of pro-cyclical assessment increases. I'd like to thank the FDIC staff for their work on providing this semi-annual update to the restoration plan and their continued efforts to monitor potential losses, deposit balance trends, and other factors that affect the reserve ratio. That concludes my statement. Vice Chairman Hill.
I just want to thank the staff for their continued work on this, but otherwise, no comments or questions for me.
Thank you. Director McKiernan. Director Sue.
I also want to thank the staff. I do have a small request, which is to continue exploring options for pricing adjustments to ease the burden on community banks. I know that's something that's been kind of discussed. It's something that's a step that we took at the OCC last year. It's been quite helpful. I know as part of the special assessment here, that was also a consideration. I think that can be an important way to provide support to a diverse banking system for community banks. So just ask that we continue at the staff level, exploring those options and engaging on it. Thank you.
Thank you. Director Chopra.
Let me echo what Comptroller has said about that, which is even when those very small institutions do fail, the likelihood of very significant losses and contagion is pretty low. And I think that also, we do factor that in, obviously, in our formula, but I think there are ways to make sure that we're allocating risk better. Just briefly, I know you've mentioned that the emergency actions to protect the uninsured depositors, of course, is being recovered from a special assessment. That is not to say that there were no losses to the DIF from the failure of those 3 institutions, because of course we had to share in those losses. I'm sorry to sort of put you on this spot about this, but do you recall roughly how large those losses were from the spring failures to the fund that were not recoverable recoverable through the special assessment?
So for the failures of Silicon Valley Bank and Signature Bank, the total estimated loss as of December 31st, 2023 was $23.6 billion. Of that, we will be collecting $20.4 billion through the special assessment, so roughly 3.2.
Yeah, I raised that because, as I recall, there was significant pushback, including from the largest banks, about adjustments to the assessment schedule. And I also recall specific advocacy that, of course, everything was fine. And I think this really illustrates that the system is always subject to fragility, and we have to be prepared for that. So I am glad that we are on pace to be reaching the 2028 deadline. I do think there is some cushion, but as you mentioned, and I'm glad you've underscored the fact that there is some uncertainty to this. So we really welcome these updates. I want to thank you for your time personally, because I know we've had ongoing discussions, and this relates to the Comptroller's comments as well, about ways to evolve the assessment framework over time. I continue to think we should look at ways to make it counter-cyclical. The chairman has raised we want to avoid, when possible, pro-cyclical assessment increases. I also think there's a dimension of we don't want to rely too much on ad hoc board action and really have a rigorous analytical approach. And I see value in replenishing the fund in positive times when industry profits are high, and some aspects of our current framework might work against that goal. So again, thank you so much for all your work on this.
Thank you. If there are no other comments from the board, may I have a motion to accept the semi-annual update on the Deposit Insurance Fund Restoration Plan? Thank you, and a second? Thank you. I'll now call the roll for the vote to accept the update. I vote aye. Vice Chairman Hill? Aye. Director McKiernan? Aye. Director Sue? Aye. Director Chopra?
Aye.
The motion is adopted. Thank you all very much. Thank you to the staff as well. So the second item on our discussion agenda this morning are two resolutions related to the Change in Bank Control Act. We will hear presentations on both resolutions first. Board members will then have the opportunity to ask questions and present statements on those resolutions. And once completed, the board will vote on each resolution individually. So I believe Director McKiernan will present the first resolution.
Yes, thank you. Thank you, Mr. Chairman. So in January, I raised some questions about the role played by the so-called Big Three asset managers in our banking system. I noted that these asset managers, thanks to the growing popularity of their index funds, had accumulated quite large equity positions in the holding companies of a number of our FDIC-supervised banks. I noted that with those investments came some very significant voting power, and I asked whether that voting power, together with the investment stewardship activities of these asset managers, might raise a question as to whether any of these asset managers should be deemed to control an FDIC-supervised bank for purposes of the laws enforced by the FDIC. I also suggested at the time that we here at the FDIC should maybe revisit how we were monitoring this issue, and in particular, how we go about confirming that these purportedly passive index fund managers are indeed actually passive. One of these asset managers has received from the FDIC regulatory comfort that provides some clarity, some guardrails around the amount of equity that it may own in these FDIC supervised banks and the activities that it may engage in without being deemed to control any of these banks. Notably, though, we here at the FDIC don't do much in the way to monitor this asset manager's compliance with those passivity commitments. We essentially just get a certification each year, call it a self-certification, that essentially purports to clarify that this asset manager has indeed complied with the terms and conditions of this regulatory comfort. More generally, setting aside these passivity commitments, we at the FDIC don't do much. That proposal would direct staff to consider, to assess each year whether any asset manager, we're looking just at a few asset managers that manage very large passive index fund complexes, whether any of these asset managers controls an FDIC supervised bank. To the extent an asset manager might rely on regulatory comfort to avoid a control determination, we would also direct staff to assess each year whether the asset manager has complied with the terms and conditions of that regulatory comfort. So it's just a monitoring plan, basically. Super simple, very basic, just monitoring. I would describe this as cautious incrementalism, maybe even to the extreme. This plan doesn't require a change in law, just requires that we enforce existing law. This plan doesn't consider, assess, affect any of the actively managed funds. It's really just focused on 2 or maybe 3 passive fund complexes. This plan doesn't require changes to or otherwise upset the well-settled passivity framework. It's just about monitoring. Just going to assess whether they're complying with existing law. So given that it's pretty straightforward, you might expect, this is a pretty easy thing for us to vote on a unanimous basis to adopt. You might expect that we'd all want to kind of lock arms here and be able to say at the end of the board meeting that the age of self-certifications is at an end. I don't think that's what we're going to end up with today. I don't think that's how the votes are going to land. And so you might ask, well, kind of what's going on here? And I think what you may hear from my fellow board members, and we'll hear what they have to offer, is a view that this effort really is better driven by the staff, not by board action. And I actually share that view. I certainly agree. Over the last 4 or 5 months since I raised these issues in January, there's been a lot of internal back and forth. Thank you to the staff for that, around how to best address this issue at the staff level. And one concept we considered that I actually really liked was that maybe we would have the FDIC send letters to a few of these asset managers that would provide something to the effect that after some date certain in the future, call it 90, 120 days, we would expect these asset managers, consistent with current law, to either file a Change in Bank Control Act notice with the FDIC with respect to their large direct or indirect equity positions in our banks, or in the alternative, they could rebut the presumption of control with respect to those investments. Now, have we gotten those letters out? I don't think we need a board vote today. And it's a little complicated. The basic idea here is if we've gotten those letters out, I think we would have found that as a practical matter, these fund complexes just couldn't file a notice for each large investment. The indexes they track, they reconstitute pretty often. And so there needs to be some kind of prospective forward clarity here on how we're going to think about these determinations. I think we'd also would have found that it wouldn't have been really practicable for these fund complexes to rebut the presumption of control on a case-by-case or investment-by-investment basis. I think we would have found that really the practical path forward here would have blanket passivity agreements with these fund complexes that, again, set the rules of the road, how much they can own, what kind of activities they may engage in without having a control determination. And had we gone that direction, we could have incorporated into these passivity arrangements monitoring provisions that would have facilitated the FDIC's assessment of whether they were controlling with the terms of those conditions, that guidance. We didn't get those letters out, obviously, so here we are having a board vote. I'm not sure kind of what the holdup here is. I'll look forward to the board discussion here. I mean, in my view, really, this is a very small step to facilitate enforcement of existing law. And if we're not going to enforce our laws don't mean much. So I'm going to keep pushing this issue. I'm going to keep advocating, hope we get these letters out soon. I'll look forward to the board discussion here. But I guess I'll just close with this. We have a couple very large passive fund complexes with very significant positions in banking organizations, non-banking organizations. They're a growing feature of our market structure. To the extent these index fund managers are indeed passive, there may not be much issue here under the banking laws. But if these fund complexes are using their purportedly passive index funds to push social policy, to influence bank policy, then there's a real and significant issue here. And there's one the FDIC needs to get ahead of before the influence of these fund complexes grows even larger. So that I'll just thank staff for all the work on this. I know there's been a lot of back and forth for the last 4 or 5 months on this. Thank the chairman for his time and engagement on the issue. And I'll look forward to the questions of my fellow board members after we present the other case. Thank you.
Thank you very much. Director Choka?
Well, thank you, Mr. Chairman, for holding this meeting today. It is particularly timely. This is our first board meeting since Sam Bankman-Fried was sentenced to 25 years in prison. He was convicted on 7 counts of fraud and conspiracy in a multi-billion-dollar scheme involving FTX and an investment fund known as Alameda Research. And during the sentencing process, the court heard compelling stories from victims who suffered enormous losses. And it's critical that we truly understand the implications for the FDIC from this massive fraud and take appropriate action. So first, I want to discuss and highlight the curious case of Farmington State Bank in the Sam Bankman-Fried saga. I then want to explain how the takeover of Farmington State Bank was able to evade FDIC oversight. And third, I want to offer a proposed change to FDIC rules to ensure that fewer suspicious changes in bank control can escape our review. So as Americans suddenly realized they could not withdraw their funds from Sam Bankman-Fried's FTX in November 2022, they wondered whether they would ever get their money back. And in FTX's bankruptcy filing was an unusual item, a deposit account held by FTX worth roughly $50 million at Farmington State Bank. Farmington State Bank was founded in 1887 and served a rural community in the state of Washington near the Idaho border. As a state-chartered bank, Farmington was supervised by state regulators and the FDIC. Its parent company, Farmington Bancorp, was organized as a bank holding company and regulated by the Federal Reserve, with Farmington State Bank as basically its primary asset. So in January of 2020, the Federal Reserve Board of Governors voted on new rules that purported to provide transparency on how it would evaluate when an entity gains control of a bank holding company. And in reality, the rule changes reduce the scrutiny of investments in and takeovers of banks. It sent a clear message that the Federal Reserve and regulators would be lenient when it came to enforcing congressional prohibitions and limitations on ownership of banks. Then, in September of 2020, the Federal Reserve Bank of San Francisco granted approval to a Maryland shell corporation, which was established by the owner of a Bahamas-based financial firm to take over Farmington Bancorp and therefore control over Farmington State Bank. It was certainly odd that the owner of a Bahamian financial firm, which was tied to the stablecoin Tether, wanted to take over a tiny rural U.S. bank. Then Farmington made another change. In June of 2021, the Federal Reserve Bank of San Francisco approved an application for Farmington State Bank to become a member of the Federal Reserve System. The following year, Bankman-Fried's Alameda Research took a supposed 9.9% stake in Farmington's bank holding company by investing $11.5 million. So there's an obvious red flag here. The 9.9% stake valued the bank at $115 million, even though the bank had only $18 million in assets and $6 million in equity. Behind the scenes, investors were reshaping Farmington's business model away from its rural banking roots and towards speculative crypto asset activities. Law enforcement would later seize tens of millions of dollars at the bank, held by entities tied to Bankman-Fried. So many individuals continue to feel the financial fraud associated with FTX. Now, the Farmington State Bank fiasco and other developments in the market have provided a number of lessons for the FDIC and bank regulators about the efficacy of bank takeover policies. While some of these lessons suggest that statutory exemptions can be exploited, it's also clear that many of our discretionary rules just don't make sense. Bankman-Fried, FTX, and Alameda Research were able to evade the FDIC in several ways. One, Farmington State Bank engaged in charter shopping. After the Shell Corporation won takeover approval from the Federal Reserve Bank of San Francisco over Farmington's bank holding company, it was also able to kick the FDIC out as its supervisor by joining as a member of the Federal Reserve System. And charter flipping has long been a concern and one that regulators need to constantly watch. But even if the bank hadn't flipped regulators, they could still have avoided the FDIC. Alameda Research's sham 9.9% investment in Farmington State Bank was at the holding company level, not at the bank level. And under the Change in Bank Control Act, this type of transaction can be reviewed by both the Federal Reserve and the primary banking supervisor. But many years ago, the FDIC instituted rules that exempt review of transactions at the holding company level and instead just defer to the judgment of the Federal Reserve when it's reviewing the transaction at the holding company level. Even though exerting influence and control at that parent level gives the investor influence and control over the bank. So given the critical role banks play in the functioning of our society and economy, Congress has put into place a number of guardrails to ensure that commercial firms and investors cannot unfairly exploit the public benefits that come with being an insured bank. So I am concerned that the FDIC's rules rely solely on the Federal Reserve for certain transactions and therefore violate our statutory responsibility to ensure that banks we supervise are operated in a safe and sound way. In many respects, it may make more sense for the FDIC to be the lead reviewer when an FDIC-supervised bank is the sole or primary asset of the bank holding company. These issues related to control do not only extend to takeovers of small banks by overseas hedge funds and trading firms. Director McKernan has also highlighted how very large asset managers are growing their stakes in banks as their index funds continue to accumulate investor assets at a rapid rate. Two asset management giants, BlackRock and Vanguard, collectively control over $17 trillion in assets. They now own large enough shares in many banks across the sector to trigger some of these statutory guardrails and limitations. In many cases, these firms claim they are passive and do not actually control banks, and they can enter into so-called passivity agreements with the Federal Reserve when taking stakes in bank holding companies to avoid these regulatory requirements. And under the Federal Reserve's 2020 rule changes and some existing passivity agreements, these asset managers can still be considered passive even if they take a seat on the board. Holding a seat on a firm's board of directors seems to be anything but passive. It makes sense for the FDIC to review the substance of its own passivity framework, take a more active role to determine whether these agreements are being adhered to, and to take action if investors are evading our oversight. And it's also critical, and I think this builds on what we just heard, that passivity agreements are not fake paperwork exercises. We need to understand any harms, distortions, or conflicts of interest posed by the concentration of ownership. So let me turn to the proposal. FDIC staff have worked, and I really appreciate all the work with us, to develop a notice of proposed rulemaking that would collect comment and make sure that FDIC can spot potential issues like the one that occurred at Farmington State Bank by restoring the agency's role in reviewing certain changes in control. The proposed rule would simply delete the exemption from the notice requirement for acquisitions of voting securities of a holding company with an FDIC-supervised subsidiary for which the Federal Reserve Board reviews a notice under the Change in Bank Control Act. The proposal also seeks public feedback on a broad range of issues under the Change in Bank Control Act, including the implications of concentrated ownership of banks by large asset managers. And we can use this public feedback to work with other agencies to inform the proposed rule and refine our approach to these applications and notices so the process is more efficient. So I'd like to offer this notice of proposed rulemaking for consideration. Let me close by saying the bankruptcy of FTX and the conviction of Sam Bankman-Fried reminds us of the devastating impact of financial fraud and abuse. The involvement of Farmington State Bank in this scheme is an important part of the story. And while the Federal Reserve Board took an enforcement action last year against Farmington to wind it down, it is impossible to ignore the steps taken to evade FDIC oversight, and we need to really have the courage to learn from this and act accordingly.
Thank you. Thank you very much. The other members of the board will now have an opportunity to make comment. I have a brief statement, and then I'll turn to the other board members. I am supportive of the notice of proposed rulemaking put forward by Director Chopra today to amend the FDIC's rules and regulations implementing the Change in Bank Control Act. Generally, under the Change in Bank Control Act, no person acting directly or indirectly or in concert with others may acquire control of an insured depository institution without providing at least 60 days prior written notice to the appropriate federal banking agency. The FDIC's current regulations exempt change in control transactions from the FDIC notice requirement when the Federal Reserve Board reviews a notice for acquisition of control of the holding company of an FDIC-supervised institution. I am not aware of another provision by which the FDIC defers by rule to another agency on a matter affecting an FDIC-supervised institution. This regulatory provision is in contrast to situations where the Federal Reserve has accepted passivity commitments from an investor in lieu of receiving a notice under the Change in Bank Control Act. In such cases, the FDIC previously has expressed that the agency would evaluate the facts and circumstances in order to determine whether a notice should be filed with the FDIC. In practice, however, the FDIC typically has not required such notices when the Federal Reserve Board accepts passivity commitments. While the FDIC values and will continue its close collaboration with the Federal Reserve on matters related to changes in control affecting FDIC-supervised institutions and the respective holding companies. It is important that the FDIC, as the primary federal regulator of state non-member banks, carry out its independent authority to review who is exercising direct or indirect control over its supervised institutions. As a result, the proposed regulatory change by Director Chopra would remove the existing exemption and harmonize the FDIC's approach, giving the FDIC the ability to request a notice of change in control or negotiate passivity commitments with a proposed acquirer, notwithstanding whether the Federal Reserve Board reviews a notice or accepts passivity commitments pursuant to its legal authority with respect to depository institution holding companies. The proposed rule also includes a request for public comment on numerous aspects of the existing regulatory framework. Public comment on the questions raised in the NPR will inform the FDIC's review of its overall approach to issues that arise under the Change in Bank Control Act and will greatly benefit our future work in this area. Director McKiernan's proposed resolution would require the director of the FDIC's Division of Risk Management Supervision to submit a plan for review and approval by the FDIC Board to monitor compliance with passivity commitments of any FDIC-controlled comfort provided to a covered fund complex and determine annually whether covered fund complexes control FDIC-supervised institutions. The resolution would also require a prescriptive set of monitoring procedures. This strikes me, frankly, as a premature step to take prior to seeking notice and comment on a significant change in FDIC rule and practice. So I first would like to acknowledge Director McKiernan's leadership in drawing attention to this important issue, but I cannot support the proposal he is putting forward today. I would also like to acknowledge Director Chopra's efforts to address this important issue, and as I indicated, I will support the notice of proposed rulemaking that he has brought forward. Thank you. Vice Chairman Hill.
Thank you, Chairman. I appreciate the concerns that have brought us here this morning. There does seem to be a contradiction when large asset managers, on the one hand, commit to banking regulators that they will be passive with respect to their investments in banks, while on the other hand, take certain actions to use their voting power as investors to achieve broader policy goals. I support Director McKiernan's proposal. I agree with the principle that we should take steps to confirm that large asset managers with passivity agreements are living up to those commitments. I do not support the staff proposal, which oddly is being introduced by Director Chopra. This proposal would expand well beyond ensuring passivity at the largest asset managers and would require a range of other types of bank investors to file duplicative notices with both the FDIC and the Federal Reserve. I am generally supportive of the principle that the FDIC should seek public comment before enacting policy changes that impact external parties, and I think this is an area where public input could be useful. For example, these proposals raise a deeper question of what banking agencies mean by passivity. As an example, our passivity agreements include a commitment by signatories not to, quote, direct or attempt to direct management or policies, end quote, and I suspect there may be differing views of what crosses that line. I think more clarity on this type of question in the future, informed by public input, could be helpful. In addition, the willingness of outside capital to invest in banks is critical to our capital framework and financial stability. We should always be mindful of the consequences of actions that could discourage capital from coming into the banking industry, and I generally believe that ensuring the appropriate level of passivity rather than restricting investment should be the goal of any endeavors in this area. Finally, I would like to thank the staff for their work and engagement on this issue. even though their normal seats are vacant today, along with my fellow board members. Thank you.
Thank you. Director Sue?
I want to thank Directors Chopra and McKiernan for these proposals. They shine much-needed light on the evolving nature of bank ownership and control and corporate governance. As noted by my colleagues, the rise of index investing has changed the composition of bank ownership. This raises a host of important questions for bank regulators, given the potential implications for safety and soundness, consumer protection, and resolvability. These questions are relevant to all three federal banking agencies, not just the FDIC. To put this in context, of the more than 600 publicly traded banks, nearly all, over 95%, issue voting securities via the holding company, which is supervised by the Fed. In aggregate, of the 4,577 insured depository institutions in the U.S., less than 20 are publicly traded and issue voting securities directly from the IDI. These statistics for OCC-supervised institutions tell a similar story of bank ownership via holding companies, with the addition that the FDIC also has backup supervisory authority for all OCC banks with insured deposits. Thus, this issue of bank ownership and control is shared across the FDIC, OCC, and Federal Reserve. We are inextricably linked on it, given how banking organizations have structured themselves. To address this effectively requires interagency coordination and, ideally, a shared understanding and approach to bank control, notices, and passivity agreements. In short, I believe we should work together to strengthen bank control assessments instead of creating more process and opportunities for turf battles or fragmentation. In addition, the issues at hand are novel and complex. The distinctions between proxy voting, stewardship, and control can be blurry. Opinions differ as to the impact and effectiveness of passivity mechanisms such as mirror voting and choice voting. For us as regulators, the key question centers on how these things impact the safety, soundness, and resolvability of banks. Further research, analysis, and debate are clearly needed. I believe any proposed rulemaking, which should be done on an interagency basis, would benefit from such discussion and debate occurring prior to its issuance or prompted by an RFI or an ANPR. Finally, to the extent the federal banking agencies are not coordinated or aligned on the issue of bank control, reallocating FDIC resources away from supervising banks to monitoring asset manager compliance with passivity commitments would be, at best, inefficient at this time. For these reasons, I'm voting no on both proposals. Now, to be clear, asset managers should continue their work of ensuring that their ownership stakes in banking organizations are truly passive and promote safety, soundness, and resolvability. Any evidence to the contrary will compel me to reconsider my posture on these issues. Thank you.
Thank you. Director McKiernan, would you want to?
Yeah, if you don't mind, thank you, Mr. Chairman. Maybe just a few reactions to the excellent comments from all, and my respects, especially Director Chopra, for quite compelling viewpoint there. Maybe just kind of in reverse order, Director Sue, I personally am quite sympathetic to the point of view that an issue as important as this really does merit some interagency coordination, especially if we're going to be changing how we think about the control framework. I guess ideally, in my view, we could get to a world in which there is a coordinated monitoring of these passivity commitments in a way that doesn't create a whole bunch of redundancies, right? And we all are kind of looking at the same thing. We think about passivity, the same thing. I do think, though, to get that started, we've got to at least be able to say here at the FDIC that we're not going to accept self-certifications. That if we're going to have a rule, there's got to be an enforcement mechanism. Otherwise, it's not a rule. That's kind of the definition of law. You got to have a court or some other authority to enforce it. Otherwise, it's what's the Pirates of the Caribbean quote? It's more like a guideline. And I don't think we're in the business of making guidelines, right? We need to have enforceable rules here, and we can't have self-certifications if we're going to have rules. Vice Chair Hill, what you mentioned here about the importance in these times of some economic uncertainty about really facilitating capital capital equity investments in the banking sector. That really resonates with me. Candidly gives me some pause around the NPR proposal, Director Chopra's NPR proposal. I mean, let's acknowledge here that the FDIC has been sued and lost on how we consider change in bank control applications, right? We had this process where we didn't accept the application until we kind of wanted to accept it, so we didn't have to start the clock. You can't have that kind of arrangement. Well, first, you can't have that kind of arrangement consistent with due process and just basic fairness. But you can't have that kind of arrangement if we're going to facilitate equity investments in the banking sector. We need to consider these applications in good faith when they come across, and if we don't like them, we turn them down, consistent with the statute. You got to deny them, not sit on them. Chairman, might just respectfully have a different viewpoint here on whether it's premature here to just acknowledge that we should not be relying on self-certifications. I take the point that the monitoring contemplated in my proposal could be viewed as granular. I think of it as kind of high level, given the staff has a lot of discretion to tailor and adjust. But I think through this letter process, we've been coordinating or thinking about we could have a more bespoke and iterative approach to what comes next after self-certifications. I just would really like to aim here as a board for us all to acknowledge that we should not be using self-certifications as our compliance regime. So, Director Chopra, that brings me then to your NPR, and maybe just a question for clarification. The NPR actually has a question in there around whether we as an agency should be relying on self-certifications, whether that's an appropriate way to do monitoring of whatever comes next for the NPR to be finalized. And I guess I'd just be curious, your views, how you think about that question. Candidly, I'm not sure we need to ask that question. I think the answer is kind of obvious, but would be curious, Director Chopra, how you think about self-certifications and an appropriate monitoring regime.
Yeah, so when I think about compliance monitoring, you typically think of it in the context of orders filed with an Article III court, orders that may be entered administratively, other letter agreements. There's lots of different ways in which that occurs throughout the financial regulatory framework. And in some cases, even written commitments are enforceable depending on the circumstances. So typically speaking, we do require, as part of order acknowledgments, we require certain individuals to make attestations that they not only acknowledge orders, but they actually completed it. So attestations and certifications certainly have a role. It's also a way to identify specific individuals who are involved. But I do think you're raising this important point, which by the way, I agree with it. It can't just be taking the word for it. Self-certification can't be the beginning and the end of that. And I do think it is important. All of us as regulators have to see that as maybe one portion of it. And I would agree. I don't know. I'm going to get your words wrong on this, but we can't just have an era that totally depends on self-certification. There needs to be something that gives a clear set of indicia as to whether the commitments that are being made in any written agreement order are actually being adhered to. And let me build on this by saying I really appreciate what you've raised about these set of issues. I obviously am highly motivated by trying to make sure that there are not harms and distortions and conflicts of interest, and that we have some laws on the books in our country about banks being very special. And we are more cautious about ownership of banks because of those reasons. And we have a number of laws that have been on the books for decades. And I think it's very clear that we can't just, we would not be comfortable if one of our supervised banks, as a board of directors, said, well, we're just going to totally outsource some key responsibility to someone else. So I really want to say the sentiment of your proposal, where investors, including of all sorts, but especially large asset managers, with these passivity agreements, I think they are often used to avoid filing other types of notices and applications. And it does, I do think we'll all continue to talk with each other on how we revisit the ways in which we ensure that there's compliance with it. I do know that there's been a lot of discussion with me and much of the staff. The chairman has really helped facilitate a lot of dialogue with all of us. I do think there are aspects that would benefit from public comment. I also do think it is important to ultimately change our rules. I do appreciate, Mr. Chairman, that you're allowing this kind of meeting for us to surface this, because I do think it will end up getting us to some sort of consensus on it, hopefully not years into the future, but to today. I do hope that my instinct would be really to put Director McKernan's proposal on hold. I want to see what really takes shape as we sharpen our thinking, and I hope that we also get some public input, including on rule changes. So again, I really want to thank both of you for this, all of you actually, but especially the entire team here, who I think has been weighing through some weighty issues as it relates to different ways that investors are seeking to influence or control. I really do feel that what we saw with Farmington State Bank, it is true, they did change their charter, and ultimately they escaped the FDIC that way. But even if they didn't, they would have been able to avoid a notice to us about some unusual investments that were being made in Farmington State Bank because of our existing rules. And so for me, yes, there's important questions broadly about control. We also have to make sure that FDIC supervised banks are not being used as part of fraudulent schemes.
So I'll just close. I know I've gone on a long time here, but Director Chopra, thanks again for the engagement on this. I take your point that there may be some role for certifications, attestations, sort of facilitate identification of the right folks. Hey, these are the full, complete documents. But it's good to hear, I think if I heard you, that certification should not be the only means of monitoring compliance. And so I think that, we seem to have at least a good chunk of the board here that's aligned with that. I'm going to keep pushing to implement on that. I think there is some devil in the details we need to continue to talk through here. And so, Mr. Chairman, I may take Director Chopra's suggestion up, to heart here, and maybe suggest I'll put this on hold, right? And if I may respectfully not seek a vote on my particular proposal, if that's okay, but I am going to continue to advocate on this issue. I think it's important that we think through the thorny issues here, very significant issues here, issues that can get ahead of us quickly if we don't start thinking about them soon with some urgency, and find a way, at least initially, to put an end to these self-certifications. So, Mr. Chairman, thank you for all the time and engagement on this. Thank you for the debate, the conversation here today. And I'm not sure the technical word here, but pull back, retract my proposal, not seek a vote on it. But I do think we have one other proposal to consider. Thank you.
I don't know what the technical term is, but I think I've got you on that request. So we'll do that.
And I'm happy also to do the same. I think there's more work to do it does not appear that there's a majority in favor yet at this time, although I'm hopeful we will be able to get there. But again, I do want to say I really appreciate you having this meeting, because I do think these are some big issues that there's really a lot of alignment on. And I think, as Director McKernan said, just getting to the details into it, as the acting comptroller said, there's obviously, we want to think of it holistically as well. So I do appreciate it.
Thank you. In some sense, to be continued. But thank you all for very thoughtful discussion on an important issue that'll be a subject of further attention by the board. I think that concludes our discussion agenda for today's meeting. Is there any other business that any member of the board would like to raise? If not, we'll adjourn this open session and we'll move into closed session. Thank you all very much.